What is going on, guys? This is obviously Jordan here, back again with another video, and I actually had a different video planned for tomorrow. Today's obviously Sunday, but I feel like today's news is a bit more poignant. It's a bit more relevant given I've got a lot of messages recently from guys saying that, oh, I started investing because I heard your videos, or I really appreciate financial advice. And I feel like I've done a lot of glamorizing in the last few videos, kind of talking about the more positive and rewarding side of being financially savvy, I guess, and investing in the stock market and stuff like that. But when you're talking about financial markets, especially my first video on the subject was to do with why I bought Tesla shares. There's obviously a big, like, not a double-edged sword per se. There's obviously a big a negative side to that argument as well, which I should probably put across before I talk about Help to Buy versus lifetime ISAs, which will obviously come out next week. That video's already been made, so that's something that you shouldn't need to worry about. That'll be out when it's out. But today's one I feel like is a bit more important. So we're going to talk about why I have started selling, or why I'm about to start selling, probably more accurately, some of my Tesla shares. So why? Okay, actually, you know what? I think the most important thing to talk about right now is the reason why. Because of course today's Sunday, so the stock market's actually closed. But I'm not actually selling my shares literally right here, right now. I'm not going to do that until Thursday or maybe even Friday, because long story short, July is the end of Q2. Well, technically June is, but July marks the actual end of Q2, where Q2 is the second quarter of the year, which is where publicly traded companies all release their financial markets, their financial records, come out, all of their talking about their quarterly profits and revenues and what they're going to do differently for next quarter to meet their targets, things like that. So it's very highly anticipated that Tesla have done well in Q2 and have a profitable Q2, which there's a lot that goes into it. If you're in the Tesla space, you know what I'm talking about already. Things to do with like the growth in Shanghai, Gigafactory this, S&P 500 inclusion, that like you can do all your own research on that. I'm not going to talk about all of that right here, right now. But Tesla's obviously doing really well, so it doesn't make sense for me to sell right now when it's highly likely that on Wednesday, when they make their quarterly financial call to their investors and shareholders, that I'm not gonna be surprised if the value of the stock goes up in the short term. But with all that out of the way, I'm still a bit skeptical. I'm still a bit not bearish per se. Like, I'm generally optimistic about the future of Tesla, but there are three kind of key perspectives about why right here, right now, I'm selling off not necessarily all of my stock, but a portion of my shares at the moment, just for for reasons I'm about to explain. So the first reason, and this is more of a consumer reason, I guess, it's not necessarily like a stock professional opinion here, but you look at a lot of the tech stocks, Tesla's, Amazon, Shopify, Netflix has actually experienced, I guess, the other end of the spectrum right now as well. And you see that a lot of these companies, Apple, Google as well, have just blown up during the coronavirus pandemic, during like the global crisis. The tech companies are the ones that seem to be doing very, very well. And that's typically because they don't actually need shops. They don't actually need storefronts to make a lot of their money. I mean, Apple, you can say, are an exception here. But Google, for example, Netflix, a lot of what they have online. They don't need to have physical presence in order to actually dominate markets. And that has been a big contributor as to why they're doing very well right now. But you can see just by looking at it that when you have a parabolic, rapid rise, anyone could kind of tell you that it's not necessarily bound to drop off. But I think Tesla's at a point right now where it can easily go either way. Like, it can go up tomorrow or it can go down tomorrow. And when you're someone like me, that obviously I have money available to invest with, but I'm not like comfortable just splashing bills everywhere. So it makes a lot of sense in the short term, as I said, to sell off some of my position, just because, as I said, they can go either way. And I'm going to be really annoyed if it just drops off tomorrow. Even though I'm up like 200% or something, it just makes sense to lock in some of that profit right here, right now, because it's very likely, as I said, that I can go either way. And being someone like me, that I do a bit of research, I do enough research into Tesla and the stocks that I actually own. But given that I'm not too caught up with the global, macroeconomic structure right now, it's a bit tough. It's a bit hard to call. And just for me, for my own personal benefit, I want that peace of mind by saying that, okay, even if it went up, at least I know that I've locked in some of that profit. So if it goes down, it's like even better, because it means that I've locked in at the peak. So that's kind of my consumer-ish opinion on that matter. Not to mention that America, like if anyone's been looking at the statistics for COVID-19, like America haven't handled it very well at all. And I wouldn't be surprised if there's a second wave of lockdowns and stuff like that. Some point, somewhere in the US, probably like August, September. But either way, that's going to have an impact on, Tesla, because if their factories have to close again, that's going to impact the amount of cars they can make. And if they make less cars and they sell less cars, and there's a lot of stuff that there's a way too much uncertainty right now, and a lot of it is in the negative section as well. Whereas like the long-term profitability of Tesla is that I'm going to go into next when it comes to my more investor perspective on it. But definitely in the short term, I think it's a bit it's a bit sketchy right now. So my consumer-ish and investor-ish perspective on this, like kind of in the middle somewhere, like a general perspective, is that it follows a principle that most of you guys who invest probably already know this term, but it's called diversification. Now, diversification literally just means having a diverse, spectrum of shares, and well, not it's shares if we're talking about the stock market, but in general, just like diversifying your pools of income or the shares you own, or I don't know, the friends you have, just so you can get a taste of different things. And also, so if one, let's talk about specifically in the stock market, if one share does really bad or one industry, say tech does really bad, it means you still have a foothold in like pharmaceuticals and beauty and automotive and different sectors. That means that even if one thing falls off, you still win overall, and you're much more likely to succeed if you have a portfolio that's very well diversified. Not necessarily just buying everything for the sake of it, but just having, as I said, a nice balanced portfolio to kind of justify, to kind of catch. It's like a safety net almost. As I said, if one thing does really bad, you have all these other ones to kind of pick you up, to balance out, to cut your losses. For me at the moment, because Tesla, as I said, I'm up about 200%. It's had astronomical growth since Corona started. I think Tesla represents about 95 or 90% of my portfolio, which is so bad. Because as I said, if it does go bad, if it does go down, if Elon Musk decides to tweet something crazy tomorrow, that could be a large proportion. Like, it just means I'm out in the open when it comes to potential losses, because it takes one moment, it takes one bad Tesla news article to really damage like all of my money, my entire portfolio. Whereas if it were more diverse, sorry, then like, okay, Tesla might be doing bad, but maybe, I don't know. To be fair, it's hard to reference any other tech or automotive company, because obviously Tesla's kind of in both of their spaces. But like, I own a stock for a company called Square. They kind of own like the name is eluding me. Cash App. They own Cash App, and I do a lot of stuff with Bitcoin as well. But like, if Tesla does really bad and automotive sectors do really bad, and some of the tech companies do quite bad, Square and Visa and MasterCard that exist in like the financial sector, they could potentially be doing well to balance out the losses over there. So at least then, if I put more money into Square and take it out of Tesla, then that's a better way of diversifying. It's a safer way of, leaving all my profits on this one, in many ways, like a speculative bet, because I don't actually know. I don't know the innings and outings of Tesla to be like, yes, for sure, it's going to grow. I'm just an optimistic guy from a consumer standpoint. And again, yeah, when I'm looking at it from that point of view, having a non-diverse portfolio that's relying heavily on one stock that's been doing really well recently doesn't make a ton of sense, especially when especially when I'm talking about how it's growing and I have profits that I can reallocate in other sectors. Okay, for the final part of this video, I'm just getting my phone re-secured back in place. I've actually taken a bunch of notes for the rest of this because I want to be 100% accurate when I talk about some of the more economic and my investor's perspective more so on the reason behind selling my Tesla stock. I think even though I'm well clued up with these terms, I think it's a lot easier if I have the notes written down, so I can actually give you specific numbers and explain in detail like why, what these things mean, and why ultimately that means that's going to lead me to sell a portion of my position in Tesla's stock, in my Tesla stock. So let's go. This is kind of like a deep dive, but in a very brief way, as to as I said, the economic investor's perspective as to why Tesla, I think, if you're in a position like me, it makes a lot of sense to be selling. So the first thing, which I think makes a lot of sense, is that Tesla, maybe not in the long run, but right now, there's a lot of evidence, a lot of data to prove, not even to suggest, to prove, to strongly correlate this to be the case, that Tesla right now, is overpriced. Now, there are probably a lot of people that are going to be mad about that, which I don't care. Like, the numbers are the numbers. But as I said, I've got the notes. I'm going to go through it quickly and explain why I think that's the case. So one thing that's kind of like a de facto point that investors kind of look for in a company is the PE ratio. Now, what that stands for is the price for earnings ratio, and that's basically how much you're paying per share versus how much the company is making per share. So it's like how for every dollar the company makes of shares, you're paying like £15 for the premium, for the right, for the luxury of owning that piece of that company. I said 15 on purpose. It's not an arbitrary number. That's because the stock market average is generally around 15. Like the average price per earning ratio of a company is around about 15. And what that means is that, as I said, you're paying about $15 for every a dollar ish, which shows it doesn't really show the company's doing well, but it's like if you're looking for an undervalued stock, you're looking for investors. If the PE ratio is above like 20-ish or 25-ish, that's usually like, it's overpriced because you want to be below the average or at the average. And of course, that's just one quick way of doing it. There's a lot more that goes into it, but typically, if your price to earnings ratio is above 50 and above like 25-20, investors aren't really looking to buy in because that means that they're either overpriced or maybe you've like missed the peak, and it's there's a bunch of technical words I can throw into it, but usually basically what that means is it's not a very good time to buy in. Now, I said 20 and 25. I said 15 to average. 20 and 25 is when it's a bit too high to be buying in that time. So what is Tesla's PE ratio right now? Is it 30? No. 40? 50? I wish. Like, I would even take 50 PE ratio. Tesla, the last time I checked, like minutes before recording this video, is 368.2. 368.2 is the PE ratio of Tesla. When I checked, that's ridiculous. Like, that's ridiculously overpriced. That says a lot about, okay, maybe in the long run, Tesla's going to be doing okay. That's probably not a good valuation in the long run. But right here, right now, when the market average is 15 and Tesla's doing 368, almost, more than 20 times more than the average, like, I couldn't tell anyone to buy in right now at like $1,600 per share. That's ridiculous. That's mad. And it's not a safe bet. Safe, I mean, it very much is a safe bet for some people, a bet, but I should say for some people, because you're not doing the research, you're just speculating. But nah, for me, that's mad. And it's like, it's that number on its own. Like, I'm going to go into a bit more detail as well, but that number on its own is kind of like a get out and stay out thing, especially if you missed out. Like, getting out is a smart move, and if you missed out, don't get in. Don't fall for the FOMO nonsense. Just leave it, call it a day, and get out. The other ratio as well, the PE forward ratio, was like 490 when I checked, and that again is ridiculous. So it's mad. Going into that in a bit more detail, of course, PE ratio, you're talking about price per earnings, but the one thing that's missed out, well, a couple of things are missed out of that number, but the most important thing, especially in Tesla's case, is growth. Now, you want to talk about growth on the topic of, like, some companies could be trading at, $10 per share, $10 price per earnings ratio, but then you're kind of looking at it and it's like, okay, they're doing really bad. Like, there's no way to tell if they're doing really bad or if they're growing and they're going to improve. And that's kind of given by the EPS. EPS is earnings per share, which says literally how much the company's earning per share. But what's important, see, I'm going back to my notes because I want to be like super accurate here. So what's important, going off of those two values, is what you have called the PEG number, or the PEG, sometimes it's called PEG. And you can find that literally by Googling. If you just Google like Tesla PEG, it will give you a number. And the PEG is price per earnings growth, which is, as I said, you want to incorporate growth to see if the company's actually doing well, to see if it actually makes sense to buy now, because the price is going to go up over time. So because because it's price per earnings growth, it's a division, you're trying to get as close to 1 as possible. You want to get, if you're like 0.5 out or 1.0 out, that's okay. I think most tech companies are around 2.5, 2.6. I think Apple is like 2.64. Most car companies, I think Toyota and Ford, are like 1 point something respectively, which is very, very good. It means that they're kind of balanced out with the rate of growth. Tesla is like 9.04 or like 9.05. That again is ridiculous. That's ridiculous. And if you're comparing it to automotive space, as I said, Tesla and Ford, Toyota and Ford around about the 1.04 mark. And if you're comparing it to tech, as I said, Google, Apple, Microsoft, all around that 2.5-ish mark. 9.04 Tesla is. That's 4 times higher than the typical ratio with other tech companies. That's almost 9 times higher than typical ratio of other automotive companies. That doesn't make any sense. That the stock price right now is really too high. I can't lie. I'm going to be completely honest. Of course, if the numbers come out on Wednesday and it's looking good, you can make an argument to justify that in the future it's going to be worth more. But right here, right now, like, if this isn't the peak, I'm going to be surprised. Like, I really think it's going to drop off and then come back up again in the future. Because, as I said, I'm very optimistic about Tesla. But right here, right now, that is ridiculous. I might have to put down the title, like, asterisk, ridiculous. Why I sold Tesla stock, ridiculous. But nah, that's it. I think that's basically all the notes I have. Oh yeah, EPS, earnings per share. I talked about that anyway. Yeah, so that's my investor's perspective. Otherwise, yeah, man, I think that's about it. So if you enjoyed, again, hit the like button. Next week, we'll be back to the scheduled post. I'm going to talk to you guys in detail about Help to Buy versus Lifetime ISA. If you haven't already subscribed, do that. And what else is there? Yeah, that's basically it. Shout out Arsenal. We slapped, should I say, Liverpool and City recently. Come on, you Gunners. FA Cup is within reach. But yeah, all you United fans out there, come outside. That's all I can say. I'm about. You can see I'm about. So come outside. Tell me where to be and when to be there. But yeah, that's it for today. I hope you guys enjoyed. Peace.